What's up, guys? Welcome to What I Think channel, the number one channel for investment tips, where investment is made fun and interesting. So today I'll be talking about sell call. Interesting. So last time I talked about sell put, where I explained put is a contract you go into, but you have to drop collateral. Just like going to the bank, you say you need like 20 million. They say, okay, no problem, I'll give 20 million, but you need an equivalent before we can give you the loan. So if you're able to pay back, you get your property back. But if you can't, we have to sell to recoup our money. So that's pretty much what sell put is all about. But if you've not watched the video will be in my description. So you can go watch the video and get a proper understanding of how sell put works. Because if you've not watched that video, you can't really understand what's going on in this video you are about to watch now. Okay, so you need to watch that previous video of how to sell put to be able to understand how to sell call. Okay, all right. So if you've not, I'm gonna wait for you. All right, go watch the video. All right. So I know you've watched the video. Welcome back. So now, sell call. So sell call is a system where you put up a contract for sale at a certain price. Okay, so let's say, for example, using Apple as an example again. Now you have 100 shares of Apple which you bought for $125 per share. Okay, so now you want to sell these stocks, all the shares, 100 of it, everything, because you can only trade option when you have 100 shares. So now you want to sell 100 of it. So what do? Now you put it on the market at your own price, but not really at your own price. There's a particular price set, but you put it on the market that, oh, I have 100 shares, and they say, okay, these are the options you have. You can sell it for either, you bought 125, you can either sell it for the 125 if you want and get paid the premium for that, or 130, 135, 140. It all depends. When we do the practical, where I'll be going through a live trade, then you get to understand clearer what this is all about. So this is more like an introduction to what sell call is all about. Okay, we'll be doing the practical where you get to see live and maybe you get a better picture. But now just to open your mind to what sell call is all about. So now you have 100 shares. You go to your brokerage. I have 100 shares. I want to sell. Okay. So now they now give you three things: the expiration, the premium, and your strike price. So the strike price is the price you are willing to sell. So now you bought 100 shares for 125. Now they're giving you that, okay, you can either sell it for 130, 135, 140, so you pick. But the thing is that the higher the price you're willing to sell, the lower the premium. Okay, so let's say you bought it for 125 per share and you're willing to sell now for maybe 129. So somebody can be willing to pay you as high as maybe $200 to buy the 100 shares from you at maybe $129. I don't know if that makes sense. Okay, this is it. Let me just quickly recap the sell put so that you get a better picture of what I'm trying to say. The sell put means that you're willing to buy 100 shares at a particular price you pick. So let's say you pick 125, but the current price was trading at 130, and you are paid a premium. and maybe that premium they paid you for that was maybe 150, but it's going to expire in a week. So if at the end of that week the price dropped to 125 or less, then you have to buy the 100 shares. So that's why the brokerage company is going to keep, or going to take the equivalent of what you are willing, which is the strike price, to pay for the stock. They're going to take the equivalent of it for 100 shares. So if you are buying for 125 per share, 100 will be 12,500. So they're going to keep 12,500 as their collateral. Okay, let me give you time for that to sink in. Okay, so now at the end of the week, the price dropped to 125. The contract is executed. You now have 100 shares, but you don't want to keep the 100 shares. You want to sell option again. So you go back to the same platform, sell, but this time you're not selling put anymore, because you now have the 100 shares. You're not selling call. So sell call is mostly for people that already have the shares or more of the shares to sell. So now that you're in your sell call platform, you have 100 shares, and now you are saying that, okay, I have 100 shares, I bought it for 125, but now I'm willing to sell it for 130. Then you'll be paid a premium instantly. Okay, so if you remember, for the sell, you got a premium instantly for 150. Now you're still going to get another premium when you put it on the call, and depends. The higher the price, the lesser the premium. So the more in the money, which is another term that is used in option, which I'm going to have a separate video to really talk about the terms used in option. So when you are selling in the money, it means that it's not too different from the price that you bought it. So if you say, okay, I want to sell for maybe 126, you're going to be paid a higher premium, and the chances of you selling that particular stock is very, very high, because the stock may eventually get to that price that same day or before the end of the week. But if you want to keep the stock, maybe you like it, you want to keep it, you can put a very high price so that you can collect premium, and the price may not be reached, and the money is yours already, because instantly you are paid the premium. Okay, you are paid the premium, and that's yours. You can do whatever you want to do with it. Drink coffee with it, or buy some McDonald's with it, whichever you want to do. Okay, so now you're getting your premium for the call. So if the price eventually gets to that particular amount you set it, which is the strike price, let's say you set $30. So if eventually the stock appreciates to $30 within the expiration time, which can be a week, 2 weeks, a month, depends, then you have to sell. But the thing is that sometimes the stock might rise to that price, or it might not within the expiration time. If it doesn't reach that strike price within the expiration time, you get to keep your premium, then release it again and get paid another premium. You see you can make money both ways. But what happens if eventually the price increase to the strike price you set? Maybe you say 130, and eventually the price increased to 140. Sorry, but you still have to sell it for 130. So whatever difference that's between the strike price you set and what is currently selling, maybe is far above, you have no control over that. You've entered the contract, you say you're going to sell for 130. So if the price appreciates to 150, 160, 200, you have to sell it for 130 because it's a contract. Okay, so that's the only downside. But remember, you bought it at 125, and now the price has appreciated to 130. So you've already made a $5 increase. Okay, you've made money from the premium. You've also made money from the appreciation of the stock that you invested in it. So in other words, it's a win-win for the sell call. Okay, it's a win-win for the sell call. So your stocks have appreciated, you sell, you make more money, and also your premium that you have paid for the person that is willing to buy the 100 shares you have. So I believe I've been able to explain what sell call is and what sell put is in the previous video. So if you are still having some difficulty understanding what it is, you can leave a comment and I will gladly provide better information as regard your understanding. I know sometimes it might be difficult to grasp at the very beginning, but if you think it's getting difficult, you can watch this video over and over again. That's why I'm going to try to make it short so that you don't feel exhausted watching it. So you can watch it over and over and over again until you get a proper understanding of what it's all about. So this is it in summary of sell put and sell call is. Sell call is that I have 100 shares that I'm willing to sell, but at this price. Then somebody is willing to now buy it for that price, then the person pay you upfront a particular amount, which is the premium. So you keep that premium, it's for you, do whatever you want to do with it. So if at the expiration the price doesn't get to that amount, you get to keep the premium regardless. The money is yours, it's not refundable. You keep that, you keep your stock if it doesn't get to the strike price. But if it gets to the strike price or more than the strike price, you have to sell at the particular strike price you entered. So that's for the sell call. So for the sell put, you are agreeing to buy 100 shares, which is one contract of a particular stock. Like the example I was using, Apple. You are willing to buy 100 shares of Apple at maybe 125 when it's currently selling for 130. So if it drops to 125, you have to buy the 100 shares. So that's why the brokerage company, for their security, then you have to have a collateral of the equivalent of the strike price you are entering, which is 125. So 125 times 100, so that's 12,500. So they're going to take from you 12,500 and hold it for the time being until the expiration of the contract. So if the contract is for a week, they're going to hold it for a week. So if at the end of that week the price doesn't drop to 125, you get your money back and you also keep your premium. So the premium for sell is non-refundable. It is yours and it is yours only. Don't refund it, okay? So that's the beautiful thing of it. So you are getting paid upfront. Even before the transaction is executed, you are getting paid upfront, so you have your money in your pocket, which you can reinvest in other stocks you might be interested in, okay? So in my next video, I'm going to be talking about the platform or the brokerage you can use to trade these options, okay? So I'll be talking about those ones that are available you can use and trade for free, okay? And get to make some extra cash and I'll show you that one in the next video. So okay guys, stay tuned, but make sure you subscribe. If you love content like this, if you want to get more of this, please subscribe, drop a comment if you don't understand, and don't forget to like this video and share with your friends that you know are money minded. Okay, if you have friends that are interested in investment, don't forget to share this video with them. We really appreciate you being. Alright, so stay safe, stay cool, and have a wonderful day. Peace.